Did you know that most of the money in the United States doesn't even exist physically? We think of money as the crisp bills in our wallets, the coins jingling in our pockets. But that's just a tiny fraction of the story. In reality, about 80% of all US dollars exist only as digital entries on a computer screen. This isn't science fiction. This is the world we live in right now. So, where did all the physical money go? The journey from tangible cash to digital code is one of the most significant yet unseen transformations in modern history. For centuries, money was something you could hold. Gold coins, silver pieces, and eventually, government-printed paper notes. It was a physical representation of value, backed by trust and tangible assets. But as our world accelerated, so did our need for faster, more efficient transactions. The seeds of this digital revolution were planted with the birth of banking. Ledgers and account books were the original databases. Then came credit cards in the 1950s, a plastic promise to pay later. This was the first major step in decoupling transactions from physical cash. The true game changer, however, was the internet. Suddenly, money could move at the speed of light. Online banking, wire transfers, and digital payment apps made physical currency seem slow and outdated. Think about your own life. When was the last time you paid for a large purchase with a stack of bills? Your salary likely arrives as a direct deposit, a digital credit to your account. You pay your bills online, buy your groceries with a tap of your card or phone, and invest your savings through a digital brokerage. Every one of these actions is a transaction without a single physical dollar changing hands. It's all just data, a series of ones and zeros flowing through a vast, invisible network. But why only print 20%? The Federal Reserve, the central bank of the United States, creates money in two ways. The first is what we're familiar with, printing physical currency through the Bureau of Engraving and Printing. This cash is used for everyday transactions, especially smaller ones. But the vast majority of money is created digitally. When a commercial bank like Chase or Bank of America needs funds, it can borrow from the Fed. This loan doesn't involve a truckload of cash. Instead, the Fed simply credits the bank's digital reserve account, essentially creating new money out of thin air. This process is called fractional reserve banking. Here's how it works. When you deposit, say, $1,000 into your bank, the bank is only required to keep a fraction of that, maybe $100, as a reserve. It can then lend out the other $900. But when that $900 is deposited into another bank, that bank can then lend out a portion of it, and so on. This cycle, known as the money multiplier effect, creates a ripple of new digital money throughout the economy, all stemming from that initial deposit. It's a system built on credit and debt, where most of the money in circulation is actually a liability someone's promised to pay. This digital reality has profound effects on our economy. For one, it makes transactions incredibly efficient. Imagine the logistical nightmare of moving trillions of dollars in physical cash every day for international trade or stock market operations. Digital money makes the global economy possible. However, it also has a direct impact on inflation. When central banks can create money digitally, they have a powerful tool to influence the economy. By increasing the money supply, they can stimulate growth during a recession. But if too much money is created too quickly, it can devalue the currency, leading to inflation, where your dollar buys less than it did before. The control over this digital money supply is concentrated in the hands of the Federal Reserve and the major banks. They act as the gatekeepers of the financial system. Every digital transaction you make is recorded, tracked, and processed through their networks. This centralized control provides stability and security, protecting against fraud and ensuring the system runs smoothly. But it also raises important questions about power and oversight. As we move further into the digital age, the concept of money continues to evolve. Cryptocurrencies like Bitcoin introduce the idea of decentralized finance, where transactions can occur without a central authority like a bank. Central banks themselves are now exploring digital currencies, or CBDCs, which would be a digital version of a country's official currency. This could mean your digital dollars would be a direct liability of the central bank, not a commercial one, changing the very structure of banking as we know it. We're witnessing the next chapter in the story of money being written in real time. From gold bars to glowing bits of code, the essence of value has transformed. So, the next time you tap your card or send money with an app, remember what's really happening. You're not just moving money. You're participating in a vast, complex digital system that underpins our entire world. A system where physical cash is more of a nostalgic token than the primary medium of exchange. This brings us to a final, thought-provoking question. If the vast majority of our money only exists as digital information on a server, who really controls it? Thank you so much for joining us on this journey into the world of digital money. If you found this fascinating, please hit that like button, subscribe to our channel, and ring the bell so you don't miss our next exploration. What do you think the future of money holds? Let us know in the comments below. We'll see you in the next video.